Monetary policies around the world is getting redefined. Now, US Fed meeting, Bank of Japan, Bank of England, European Central Bank, all in the new technocrats' decisions to reignite the monetary policy, support the economic momentum. US Fed meeting, US economy is heading for its strongest growth in nearly 40 years. The Federal Reserve said on Wednesday, and central bank policy makers are pledging to keep their foot on the gas despite an expected surge of inflation. Fed officials, in fact, expect economic growth to remain above trend for at least 2 years to come, at 3.3% in 2022 and 2.2% in 2023, compared to the estimated long-term potential growth of 1.8%. So that's the growth momentum we are seeing. While inflation is expected to jump to 2.4% this year and above the central bank 2% target, Powell said it's viewed as a temporary surge that will not change the Fed's pledge to keep its benchmark overnight interest rate near zero, as a part of an effort to ensure economic wounds that pandemic are fully healed. When it comes to Fed officials now expect inflation to remain tame as the unemployment rate drops, a calculated gamble under which the new approach that emphasizes on employment gains and downplays inflation risk. Powell noted strong bulk of the policy setting Federal Open Market Committee anticipates no interest rate increase until 2024, and added that it was even too soon to talk about scaling back to the scaling back the 120 billion treasury bonds and mortgage-backed securities that is the Fed is buying each month to further prop up the economy. So they have ongoing mortgage-backed securities bond buying programs. FOMC policy statement, which kept the benchmark overnight interest rate in a target range of 0 to 0.25, was unanimous. After the rise in the price this year, the Fed expects inflation to fall back to 2% in 2022. Now, US 10-year yield 1.72% by end of the last week. 30-year yield was 2.433 by end of last week. So it is up and up. Let's see where it goes. Bank of Japan, 19th March, they had a meeting yesterday. The Bank of Japan will continue to buy equities up to the maximum of 110 billion, that is 12 trillion yuan a year. But under the new policy, central bank will intervene when the market falls rather than steadily increasing its holdings as a way to spur investments and stimulate economic activity. Bank of Japan has scrapped its pledge to buy an average of 6 trillion yen a year in equities as the central bank edged away from aggressive monetary stimulus in favor of more sustainable policy. Bank of Japan said it will allow more fluctuation in a 10-year bond yield and launched a scheme to subsidize bank profits so that they did not suffer from negative interest rates. Central bank kept the overnight interest rate on hold at minus 0.1%. It will continue to peg 10-year bond yields at around zero, but they will be allowed to fluctuate by plus or minus 0.25% instead of the previous 0.2%. So the benchmark 10-year yield now is 0.113 by Bank of Japan. Now, Bank of England, 18th March, they had a meeting. Bank of England has held interest rates at 0.1% and bond buying programs 895 billion, thereby diminishing expectations of the change in the immediate future. The Bank of England upgraded its outlook for the UK economy on Thursday, but stressed it was in no hurry to reduce the support to boost the recovery from coronavirus crisis. After the March Monetary Policy Committee meeting, the central bank said the financial market moves in the past 6 weeks, which have been stelling, and the cost of government borrowing rise, have been warranted by the better immediate prospects for recovery. However, it said MPC Monetary Policy Committee, that is, does not intend to tighten the monetary policy, at least until there is a clear evidence significant progress is being made in eliminating spare capacity and achieving 2% inflation target sustainability. Bank of England meeting, UK 10-year yield was at 0.838 by end of last week. However, the bond markets took Bank of England relaxed attitude last week as a reason to sell off again, further raising government borrowing cost. The yield on 10-year gilts rose more than 0.05% on the day to hit 0.9% at lunchtime. Now, ECB meeting, 10th March, European Central Bank opted to keep the interest rate unchanged as on investors watch closely for clues on what it might do about rising bond yields. Bond yield in the Eurozone have been rising since February following their United States counterparts' higher effects of President Joe Biden announced a massive fiscal stimulus plan. The ECB also decided to leave it Pandemic Emergency Purchase Programs or PEPP at a current level. The scheme was introduced in March 2020 in the wake of pandemic and currently scheduled to last until March 2022, totaling 1.85 trillion euros. That is $2.21 trillion. ECB has called on the various governments to step up their fiscal responses. It's not only monetary policy, it's fiscal policy also plays a role, arguing that the burden cannot lie solely on the shoulders of the central bank. The European Central Bank agreed to an unprecedented level of fiscal stimulus last year, but these funds are only due to be dispersed for this summer onwards. So, plenty of alignment is required between the monetary policy and fiscal policy in concept. But the monetary policy has been quite easy, and they're going to keep the lower interest rate. We have seen the reflection in Bank of England, ECB, Bank of England, and also Bank of Japan and the Federal Reserves. So all are cohesively evolving to support the global economic momentum. We live in an interconnected, interdependent world. We need cohesive strategy for monetary policy by the technocrats, that is central bankers.